The book covers quite many topics, and the book is the result of a conference held in Norway for the bicentennial anniversary of the bank, of a central bank in Norway. And it's a collection of 14 chapters, plus an introduction from the editors, written by mainly practitioners, policymakers, and experts, academics, experts in the subjects. The topics, again, are very broad, but they cover from central bank independence to which should be the best monetary policy a central bank can adopt in times of crisis and in normal times as well. What about financial stability or instability, how to cope with it? That's a major concern nowadays, and it has been covered in the book as well by other authors. And many other topics, like for example, how the roles of central banks, the functions of central banks have evolved in the last 2 centuries, and in particular after the outbreak of the recent financial crisis. So I would say that it's a very interesting book, suitable for a very broad audience. Nearly, I was going to say that anybody interested in the understanding of the economy, of modern economies, should understand in the first place how money is created and how central banks intervene in the market in order to stabilize the amount of money in circulation. So it's pretty key for anyone interested in economics in order to analyze how economics work. In particular, I would recommend it to, well, policymakers, practitioners, and students, graduate students in masters and PhD students doing anything related to monetary economics. Well, I wrote this chapter along with my colleagues, Professors Forrest Capey and Jeffrey Wood. Jeffrey Wood is a colleague of ours here. He's a professor in monetary economics, and he's a world-leading expert in this field, in central bank independence. And our colleague Forrest Capey, equally, he's a leading expert in the subject, and he used to be he's a professor in Cass Business School, and he's the former official historian of the Bank of England. So indeed, I was very lucky to have them both with me writing this piece. The topic of our chapter is central bank independence, but not just central bank independence for all countries or for all central banks, but for a very selected group of countries, the so-called small open economies. So we concentrated on these countries, and what we did is to collect information from the late 19th century up to the outbreak of the recent crisis, so from 1890s up to 2008, 7 or 8, and we compared how independent central banks in small open economies were as compared to other economies. And we saw, according to the data, that central bank independence is better preserved in these small open economies. And this is a sort of a pattern throughout more than 100 years. And the second thing we found out, could be the second result of our paper, is that it's not even that, but these countries performed better in terms of inflation. So they were more independent from the government. Central banks did conduct monetary policy much more independently from the government. And secondly, the rate of inflation was much more moderate in these economies as compared to the average of other economies. So it's a pretty important, I think, result. Well, I've been involved in my research with Professor Wood for now how many years? Quite several years, 12 years. I first met him when I was doing my postdoctoral year in Cass Business School 12 years ago, and he was my supervisor at the time. So yes, both of them have taught me very much about central banking and monetary economics, and we have been working together since then. Yeah, we have a couple of more chapters coming in edited volumes. One of them is about, again, monetary economics, I'm afraid, and financial crisis. So with another colleague of mine, Professor Peter Schwartz, who is also a visiting scholar here, he comes in the summers, along the summer, we wrote a paper on how to exit a crisis when you have full control of your own currency, as compared to other countries who have delegated monetary powers to a supranational central bank, such as the Eurozone countries. That one is coming fairly soon, and I will let you know more in due time. First of all, we should define a little bit what central bank independence means. By central bank independence, we usually refer what is called in academia formal independence or operational independence, which means we don't want the central banker to take orders from the politicians. We want an expert in the subject dealing with this very high technical matter. So again, we don't want the political interests or the political cycle to drive monetary policy decisions. We want something much more consistent, much more reliable. So that's the reason why in the last few decades, most central banks, and especially in developed economies, have been granted independence. And how? Well, this independence has been granted in law, in the so-called constitutions or statutes of the central banks. In the case of the Bank of England, in the recent 1998 Bank of England Act, it was granted independence from the government. So essentially, the Bank of England does not take orders from the executive, from the government. So why is it desirable? Well, again, we want a consistent monetary policy. We want it to be based on technical reasoning or rationale rather than on political reasons. Because at the end of the day, we have observed that the more independent and consistent monetary policy is, the less inflationary the economy becomes. We don't want to have very volatile prices and high prices over the cycle. And this is what happened in the years when central banks were very much dependent on the government. Yes, it is. At least formally speaking or legally speaking, this operational independence we talked about beforehand is granted by law, by the 1998 Act, Bank of England Act. And then you may want to discuss how independence it is in practice, but by law is formally independent. We may want to make a distinction between this operational independence we have been talking about and goal independence. Even for the Bank of England, the goal, the mandate, the target the Bank of England must achieve is not decided by the bank, but by the government. So the government specifies the rate of inflation the Bank of England must achieve at the end of the year. But it's for the Bank of England to decide how to do it. So do you see these two levels of independence? It's not independent as regards the selection of the goal, but it's independent as to how to achieve that goal. In order to understand how important central banks are in our economies, if I may, we need to talk a little bit, if only for a few minutes, about how money is created in our economies. What we call money is not just cash, metallic coins or cash and notes in circulation. We make our payments mostly by transferring money from a current account to another current account. So that's what we call bank money. So essentially 80 or even 90% of all our transactions are paid with bank money by transferring money from a deposit in a bank to another account, to another deposit of somebody else's. So given that banks, commercial banks, are able to expand deposits as much as they wish, well, virtually, theoretically there is a limit, but virtually they can do it to a great extent, we need an institution to lend out the money to the commercial banks in order to be able to meet their obligations. So this is how it works. You have a commercial bank, Bank A, being willing to expand the amount of money in circulation. So giving out more loans to the public and expanded what we call the balance sheet of the banks. More deposits available in the economy, more money effectively. So what the bank does afterwards is to go back to the central bank in the country to ask for a loan, to have reserves, cash, in order to meet its obligations. So that's how it actually works. So we have the central bank acting as the lender of the commercial banks at an interest rate. And this is the so-called official interest rate in the country. How high or how low this interest rate should be depend on the target given to the central bank. So what the central bank must do in our economies is to try to preserve monetary stability and price stability, and will fix the amount of money circulation accordingly. Yeah, so you can tell that central banks are key for two reasons. In normal years or normal times, because central banks provide regular lending to the commercial banks, and in bad times, in crisis times, let's say a banking crisis, the central bank is the only one willing to provide extraordinary lending to the commercial banks. Because a bank may become illiquid. By illiquid, we mean that it's running short of cash to attend its obligations, but it doesn't mean that it's insolvent. The value of the bank's portfolio, the assets, may be higher than the value of the liabilities. And you don't want to have a panic in your economy. You don't want people queuing at the bank asking for the money. So what you do as a central bank is to provide this extraordinary lending at a rate as well. So these are the major functions of a central bank. To preserve price stability, but also, and very importantly, to preserve monetary stability and financial stability as well. After the crisis, we have seen that central bank independence all across the board has been compromised. And why is that? Because, as we talked beforehand, it is this central bank independence is granted by law, and is written in the constitution. But can you foresee any possible crisis coming in the next few decades and the consequences of those? No. So it's impossible to draft and to put in writing a full or complete contingency contract. There are some foreseeable events that will happen. And when this happens, in a crisis, for example, the government will find the opportunity to step in and ask the bank to take extraordinary actions. So in times of crisis, it's almost inevitable for the government to interfere with the mandate given to the central bank. And this has happened, indeed, in the recent crisis, in 2008 and 7 and 8, basically. So what you have to do, in my view, is rather than struggling to write such a complete, impossible to draft contract to preserve the independence of the central bank, is to grant the central bank a very clear mandate. That's the best you can do. This is what Milton Friedman in the 60s suggested, and I still think that is the best way to preserve central bank independence. And the other two consequences coming out of the crisis is that we should pay much more attention to how much money grows in our economies, the rate at which money grows in our economies, both before the crisis in good times and during the crisis. Because what we want to avoid is an excess in money growth in normal times. We want money to grow more or less along with the rate of growth of the GDP in our economies, no more, really, not to be inflationary. But in bad times, during the recession, we want the central bank to prevent deposits to vanish, to prevent money to vanish from the economy, because this in turn will be even more harmful for the economy and it will deepen the recession. This is a major lesson we have learned in recent years.